Welcome to Onyx and the world of oil derivatives, a podcast that lifts the veil on the opaque world of financial oil trading. Brought to you by Onyx Capital Group, Oil Derivatives Deciphered.
Hi again, and welcome to another episode of Onyx and the world of oil derivatives. My name is Greg Newman, and I'm the CEO of Onyx Capital Group. And on today's episode, I'm discussing the role of the exchange on oil derivatives. With me to discuss this is Michael Wittner, who is the current head of oil market research at ICE, or the Intercontinental Exchange. Michael is very experienced indeed. He has worked at research agencies, he's worked at oil trade houses, and most recently banks before his role at ICE that he's been doing for over a year now. Now, Michael has some very interesting perspectives. We discuss everything from the dynamics in the oil market, the improving or increasing financialization of oil and the democratic nature of the oil market. And I really enjoyed the conversation, I must say. I expect you will too, and thanks for tuning in. Hi, Mike. So thanks so much for coming on. We've actually tried this once before, but had some technical issues, but I'm sure it's going to be a very interesting conversation again. So I guess just to kick off with, Mike, you've got a lot of history working with banks, particularly in research. A very long history in very different many areas, a lot of experience. So what are you doing now at ICE, and how's it going, I guess?
So at ICE, I'm heading up a team of an oil market research team that is, we work very closely with, and in fact are embedded within the business development and sales team. So our job is to, among many things, is to, as well as being, the public face of ICE and doing things like this, our job is an important one. We try to understand and look ahead, and see where the oil market is going, with an eye towards making sure that we are evolving and our products are evolving to provide the risk management and investment tools that the industry wants. So in other words, what's going to be the next U.S. shale? What's going to be the next IMO 2020? Things of that nature.
Well, the exchange has done a great job, a fantastic job in creating a much more democratic oil market, financial oil market. But that's why I thought we'd start, how this came about. So the podcasts in general that we're doing, focusing on different areas, and we had one on commodity financing, allowing physical traders to move all around the world. But of course, what the exchange have done is largely, to some degree, replace the banks in the facility to trade, and doing so through, clearing houses rather than direct credit lines with banks. And that happened, pretty got going around 2012. So I guess just starting on that, you were saying something really interesting before about the contract growth. I mean, we went from some benchmarks to reflect the general oil market, but now these days we're into highly granular plethora of, optionality for what you want to hedge, and what you want to speculate on. And like you just said there, you're constantly looking for how you introduce more. So just talk a bit about that transition and how it happened and how quick it was, because we're only talking less than 10 years and it's a staple now in the oil market.
Yeah. So 2012 was really a key watershed. So in 2012, of course, we got the DoddFrank regulations came in the U.S., which really affected commodities trading around the world. And as everybody knows, that was a result of a reaction to the global financial crisis and Great Recession in 2008. So the first thing to understand is really at the center of the transition that happened there. It was, in 2008 and the immediate aftermath, it became really clear, really quickly, that counterparty risk, credit risk, was a big thing. So basically counterparties didn't trust each other, didn't know each other well enough, not because anyone thought anybody else was a bad person or anything like that, but the business conditions were so extreme that just to manage your own risk and to be prudent in your trading, you really had to find ways to manage that, and really the biggest or one of the biggest things, and that was very easy to put in place very quickly, was to switch from bilateral swaps to clearing, to doing your trading and clearing on an exchange, and that basically put the burden of the credit risk on us, on the exchanges, rather than counterparty to counterparty. And so what happened there was, as you just mentioned, the number of products exploded. The number of oil products, both crude oil and refined products that we offered went, more than double. It went from around 275 in 2012 to more than 600 at present. And that had several impacts, right? On the nuts and bolts of trading, it meant that, this move to clearing, what did that mean? So you start to get margin offsets, which is a big and important step in lowering costs of trading.
Well, that's the thing. I think we probably need to take a step back, just, what it actually means to trade on the exchange. The unfortunate thing right now is that it's not highly accessible to absolutely everyone, but I do think we'll get there, right? And I think you still can get there via ETFs that track indexes, but the increased financialization of oil and the contracts, the more speculation coming in, means that a lot more people can participate. And there certainly has been a lot more financial players involved because of that. And as I say, we can open it up to the retail community as we continue to grow. But I guess as it stands right now, to summarize the exchange functioning, they offer all these contracts. They provide settlement prices to which you're agreeing a price relative to. So when it comes to, a cash settlement, that will be all really standardized and straightforward by the exchange. But the access to market comes through either you can yourself be a clearer, you can act as an exchange member, or you can go through a clearing bank. And I guess why people don't generally be exchange members is because there's just huge liquidity requirements, huge cash requirements yourself. Right. So for instance, Onyx, we go through a bank, and really it's actually the bank facing the exchange, and then we have an account with the bank. So it's all very centralized, standardized, and it works very, very well. It's just, as I say, we're not quite there yet where it can be such that we can offer it out to everyone else. But sorry, continue to what you were saying.
No, well. So those are very good points. That actually leads me to my next point. So aside from lowering the costs of trading and making your use of capital more efficient, in terms of the big picture, there is still room to go, no question about that. But it created much more of a level playing field. The number, in terms of giving access to the markets to more and more people, the number of ICE customers between 2012 and 2020 went from 360 to 780 plus, right? So it's more than doubled, in other words. And it does allow smaller participants and the rise of more independent traders. The higher number of participants includes both commercial participants, the oil business, in other words, producers, consumers, refiners, physical traders, as well as many different types of investors, from the retail ones that you mentioned to many types of index funds, pension funds, asset managers, etc.
It immediately leads to that argument. Well, the debate as to financialization of markets, is that a good thing? I mean, I don't know where you stand on it, but I being a financial player, myself with Onyx, I unequivocally believe that financialization is good for the oil market. So, you were saying before, you got a limited number of contracts when we first started. You had to have a credit line with a bank. They wouldn't offer you a line unless you were huge, unless there was a reason to. and they to a certain degree controlled the market because they controlled the pricing and the rest of it that you needed to get. Since the exchange had come in, and this democratization is another way of saying anyone can participate that has access to the exchange, can profit from discrepancies in oil prices that don't make sense, or arbitrages that offer themselves. And I just, why I'm passionate about this is because the more financialization we get, the more liquidity we get, the more fairness there is. Because when people say, oh, but the financialization pushes things out of whack, I think, well, how does that make sense? Because ultimately what's great about the oil market, especially the swaps, especially these like price reporting indexed swaps that are so popular now for hedging, that's settled to real physical in part, real underlying physical. So if things get too out of whack, you're basically giving free money to whoever has the oil. They'll say, okay, great, you've just pushed up the price for this particular contract that relates to this particular oil. I'm going to sell it because I have that physical oil. So basically it naturally keeps things in check. So all financialization does is mean that the liquidity is improved and the accuracy of the contract is so much higher at any one point. And it doesn't really go beyond that. Do you agree?
I do agree with you. And I would add something from a different angle. So number one, most importantly, top of the list, absolutely, is that financialization of the oil market. So in other words, the development of commodities and oil as an asset class for many different types of investors. It adds liquidity. If you are a commercial player, again, what we think of as the oil business, the producers, consumers, refiners, traders, you need liquidity from somewhere, right? To always, this may be obvious, but you always need someone on the other side of the trade. So anything that creates liquidity helps that, right? So that's strongly agree with you on that. The other thing is that, periodically, and now I am thinking back to 2012 and 2008, whenever we get extreme moves in oil prices in either direction, you're undoubtedly, you start to get a debate about, well, was it real? Was it driven by fundamentals, or was it driven by, the funds, by the money? And something interesting has happened, right? In the beginning, and I'd say in the decade of the 2000s, when oil when the financialization really was taking off, was brand new, a lot of the money then, maybe even most of the money, was in kind of, the plain vanilla index funds. Asset managers say, okay, I'm going to put X percent of my pot of money in an index fund, and it was just there. But that was only stage one, right? And you could argue at that point in time that, by just putting money in, regardless of the fundamentals, like that it was not driven by fundamentals. Things have changed a lot by 2000, by the last decade, and we're focusing on 2012 and onwards. Financial players have learned. In the beginning, they didn't know the oil markets, but now they know the oil markets. And I would argue that the many different types of investors also look at fundamentals. That's the key thing. They're looking at the same fundamentals that the commercial participants are looking at. Yes, there are times when investor flows can add momentum to a fundamentally driven price move in either direction. Maybe, but the bottom line is they're still caused by the same fundamentals. And I think that's a very important point, because people miss that sometimes.
Well, that's why, I'd love to see much more interest in the swap market. And I think part of the reason why there isn't is because even when you say the word swap, people get confused. It's not like a classic swap, fixed for floating. I don't really like to think of it like that. For all intents and purposes, when we say swaps, what we mean is actually futures, just like any other future. They're just priced daily to an index, and that index is settled to real physical oil. And if we were to see a lot more interest, financialization into the swap market, people would be able to trade much more fundamentally. There's that complaint about, oh, the index fund's doing this and that and whatever else. Well, if you're to trade jet fuel instead of Brent futures, and not just jet fuel as a generic jet, you're going to trade the jet Mediterranean contract because you hear that, some Spanish airport is closing down. That's very granular, and it's therefore a really good expression of what you're trying to say. So what I personally love about the swaps market is, of course, it offers you so much granularity in your hedging, but also speculation. I mean, it's its own ecosystem. When you have like an earthquake or a natural disaster, you'll say, okay, I'm going to buy these stocks that relate to, natural disasters. This is going to suffer, so I'll sell these stocks. You almost have that with oil. If something happens, you can bet that there'll be one part of the oil market, for instance, the petrochemical areas, that might improve. For instance, right now, all the VC demand, everything that's come out of COVID has really improved petrochemical prices and the naphtha prices. And then at the same token, diesel's done really badly. But if you just say generically oil's down, what is that really saying? Are you saying just the crude oil you dig from the ground is lower? But actually even worse than that, when you read on the Financial Times or whatever you go to see the oil price, you're looking at Brent futures and WTI futures, which are their own localized things with their own speculative open interest that don't really compare when you want to talk about actually what's going on in physical oil. So personally, I'd love to see a lot more interest. And I think it's going that way because surely all the contracts that exist right now, I mean, I don't know the statistic, but surely all the swaps that exist year on year for the last 10 years, they must have all increased in volume, I would have thought. I mean, I guess it's hard to define, but for the most part, you would assume that. I mean, it's definitely growing in interest, I guess is what I'm saying.
Yeah, well, just on the, without getting into all the numbers, though, it is the swaps that are now traded on exchanges. So swaps to futures is, one of the terms we use. The average daily trading volume since 2012 have basically tripled. Open interest has doubled. Right. So it is, again, in line with the increase in customers, in line with the increase in products. There is, and it is definitely true that the markets have become more and more granular as the number of participants has increased, and their needs have, at this point, again, the level of expertise and knowledge has also, ramped up tremendously. And again, whether you're a commercial player or an investor, your trading books are getting bigger. They're getting more detailed, and people already going down the road that you've just described. People want to do very detailed, very specific things. And again, that's our job, is to listen to that and try to provide those products. But it's going to continue to grow. I think one of the interesting things you mentioned, just worth touching on briefly though, is again, we definitely, since 2012, there were definitely some, if you will, some winners and losers as far as the types of players. Again, the banks, still important, but they did, they found the going a bit more difficult as participants wanted to move on to exchange again to manage that not to have to deal with that counterparty risk. And that a large part of the commercial hedging business was picked up by the physical trading houses instead, and also the trading arms of the major oil companies.
But where do you stand on, as we get more financialized, because we're growing, how would you say, we're growing outwards, many different contracts. And actually, because you need a contract for every time there's a specification change, right? I mean,
right.
Even if you kept oil as it was, you're going to need more contracts to accommodate some of the regulation changes that are inevitably going to happen.
Absolutely.
But that being the case, you have so many different contracts, and we're going towards even more granularity. For instance, petrochemicals, there isn't actually a granular market for that. There's a granular market for naphtha, which is used to crack into petrochemicals, but there's still a way to go there. There's LNG, these kind of things. People seem to obsess with the idea that we're going to go algorithmic, we're going to be systematic trading. And where do you sit on that? Because just quickly, I can't see the logic in that, because if you're growing that way, and we're talking about the exchange, when you trade on the exchange, you have the availability to trade one product, yes, but it's in every location you can think of. every specification you can think of, and then almost every time you can think of. Like for just one contract, you've got, March versus April versus May, all the way down to 2023. You've got products against products. So, how's an algorithm or systematic trading meant to provide enough depth for every single contract? You know what I mean? Each version of the contract or time spread or whatever at any one time. I think it's insane that people think it's going to happen. And I think it's just because they're looking at something like foreign exchange, which has however many contracts they have, but it's all, now, especially for instance, the EU, when the EU happened, we had all these foreign exchange contracts that just all went into one, right? And oil isn't even close to like that. It's getting more granular. So where are you on that side of things?
That's a really interesting question. I would tend to agree with you. I mean, there's a long way before the oil markets are fully automated. Now, it is fair to say that a lot of people are doing a lot of work, and there is more and more algorithmic trading. I mean, that's fact, right? We can see that. We all know that. And that's going to continue to increase. But the oil markets are very, as you say, they're very complex. And it does take some, human judgment, a lot of human judgment to decide what positions you want to put on, the size of those positions, the degree of conviction you have, right? Or is some signal like just tipping over into a buy or sell, or is it screaming that you have lots of confidence? So all those things are very hard to quantify. There is a lot of work being done. Again, the banking side that I've recently come from, people are it is happening, but there's a long way to go. There's still going to be a need for people like you. The other thing I'd mention just real quick is the data, right? We have, even compared to 5 or 6 years ago, the tanker tracking that, uplinks, to satellites, and people can get real time for, very low price, satellite imagery, mobility data, things like that. That's also part of the mix. I mean, the fabric of the oil market, the supply and demand itself is not changing, but the way we see it, we're getting more and more tools that are cheaper and more widespread. So that's a part of the mix as well.
That's further on the democratization of the oil market.
Absolutely.
But if you look at the Brent and WTI futures again, it's flooded with systematic trading, automated trading. It makes sense. It's so tight. You can get, there's a billion reasons why to trade. Pattern recognition, as you say, reactions to headlines, historical, machine learning type things, and that all works because you have immediate ability to execute. You have trading data that's so granular with volume data, all the things that these guys need. But then you trade the more granular contracts, the swaps that are related more to physical. I just think you can't really do it because, for something to be automated, you would need the exchange to have liquidity on basically equivalent liquidity that it has on Brent on every single swap contract, of which there's probably, sorry, you said it's almost 1,000, right? So and then within that 1,000,
600,
600, within that 600,
big number.
Yeah, but then that's what I'm saying. Within that 600, you then have probably, if I was to estimate it right now, if I was to say Sing 92 gasoline, the most, is a specific 92 octane Singapore gasoline that's already very basis granular.
Right.
That has the East West, that has its differential to the 95 octane, that has time spreads, it has versus the crudes. You've got probably just within that hundreds of permutations. So how is a systematic model meant to keep up? And then it's not even like people think like you can just trade one thing against the other. There's also different settlement methodologies. There's different calendars because of, Chinese holiday will be different to a European holiday. So there's overlaps there. If you trade a Singapore time zones, it's there's so much. So I just don't see it, but that's just, I guess I'm talking my own book, aren't I? Because that's what Onyx do. But it's just, I think where we're heading is more transparency, more democratization in a really positive, interesting way. But I think it's resilient to the automated algorithmic trading, which again, actually is a good thing if you're a retail speculator, institutional, you want some exposure to it. I think it's a lot more interesting market than what you're getting like the Brent and WTI, because do you want to compete against algorithms? I mean, Andy Hall, a historical kind of oil veteran funds, I think pretty obsolete now. I don't think he trades, but he was putting down his trading performance to algorithms on Brent. And I guess he was trading the Brent or WTI contracts. Didn't really see the logic in it, but ultimately, if he's trading those contracts, then he's up against machines. But if you trade the swaps, you're up against people, one, and their biases and whatever else, but you're also against real fundamentals. And there's so many options. I think it's just like a great time to be in the market.
I would just say though, there's you and Onyx, for example, and your competitors, and the commercial players, and and the physical traders and so forth. You guys are experts in all of these details, which is great, and obviously the market needs that. It depends on where you sit, what the needs are. There is for some types of investors, it could be a professional, it could be an asset manager that wants to simply invest in an index fund and let someone else deal with it. Or it could be a retail investor. There is I'm not disagreeing with you, but there is a role for certain types of investors. They're simply saying, you know what, I think the economy is going to recover from the low point it's at right now. Oil is a part of that. I want to be invested.
It's a good vehicle to explain it on a generic.
Right? So all I'm saying is it depends on where you're coming from. Everybody has their own needs and their own rationale. And in a case like that, is Brent going to capture the nuance of Singapore gasoline versus other grades, or Singapore gasoline versus European gasoline? No, it's not. But is Brent a good way to have a view, a good instrument to monetize your view on the global economy? Yes, it is. Right. So it just depends where you're
I take that point, absolutely. But then when you talk about WTI going negative, people still say to me, but could oil go negative again? And then what do you mean oil going negative? WTI went negative because it's in Cushing in Oklahoma, and it was a very localized event. And by the way, it didn't even settle negative. It was just there from a financial point of view for very briefly. And that's what's slightly, I think frustration is the wrong word, because we're on that kind of educational curve. But as I say, I would just like to see more interest in what we're doing, because obviously it's good for us, good for the exchange, more volumes, good for Onyx, which we're trading. But it's also just a lot more interesting and specific. But I guess it's still a really good point you're making. But I guess the big difference, we might as well say it, because we know the oil markets. We can't assume people know, to the same degree. But if you're going to choose what you just said, a representation of a global recovery, maybe a hedge against inflation or whatever it is you're doing, don't choose WTI, choose Brent. The reason being is a global benchmark. Why? Because actually Brent is actually based in the North Sea, and you can literally move Brent all over the world. You can't move WTI all over the world. You have to get it through pipelines to the Gulf Coast first. So that would be my very generic one-liner to say that's why Brent is a better instrument than WTI for doing what you've just said. You agree with that?
Yeah. Well, obviously I agree with you, but I wrote a paper on that. It's on our website, earlier this year. As an oil market analyst,
you can just type Mike Wittner ICE and it'll come up on Google, or
I think if you just Google ICE Brent, you'll get to our webpage, which has a lot of educational material like that.
Okay.
On it, and that paper will be right there. What I was going to say is, as an oil market analyst, with more than 25 years of experience, you can be. I'm not just saying this because I work for ICE now, but if you're very objective, and as you say, and look at the facts and look at the history, this is not, WTI going negative in April was the first time any oil futures went negative, but it is definitely not the first time. There have been very big distortions in WTI relative to Brent and the rest of the world. And as you say, it's a local crude versus a global crude. It's landlocked versus waterborne, which makes a huge difference. I could go on, but the interesting thing is you can measure these things. You can look at the historical vol, for example, which is 3 percentage points higher for WTI than it is for Brent. You can look at time spreads. Again, you can measure that. You can just look at any number of things. You can look at roll yields over the years. I'm not defining all these terms. Again, I'm assuming your listeners know that. But again, it's not just me saying these things. And by the way, pretty much every analyst out there was putting out similar things in the aftermath. So this is not me talking my book. But the point is, it's measurable. You can be objective and measure these differences. So yeah, if you want to invest, Brent is the best way to do it.
You can certainly forgive the institutional investor, the retail investor, because they're just, even myself, if I wanted to trade on my own personal account, oil, my only options are Brent and WTI, or through an index, through an ETF that tracks an index. And it's probably going to have some exposures to WTI. What else can you do? You expect to open up the FT and say, right, oil's up or Brent futures are up 10%. My contract that I've chosen should be up 10%. But we know that doesn't happen. They hold it in different months. I think there's a lot of work to be done to accommodate the institutional investor, and that will be beneficial for us all. But I think
there's definitely a lot of there's definitely a lot of room for people like us to educate investors. That's the bottom line. It's education, as you say. And again, for someone relatively new, this could be for a professional investor, could be for a retail investor. But if you're relatively new to commodities and to oil, number one, it's not an equity. So prices can go lower than 0, point one. Point two, again, it's never happened before, and it has never happened for Brent. But point two, when you're investing in an instrument, you're not actually buying a crude contract. You're not actually buying what you're reading about in the FT or what you see on CNBC or Bloomberg. You're buying a fund which itself holds those assets, and things like the shape of the curve make a huge difference in your returns. So we have to educate people about that.
That's absolutely the case. So I guess moving to more markets, obviously, an incredible amount with all your experience. What are you thinking right now? Okay, we've gone over the talk. It's kind of old news almost now about this vaccine and improving the economy next year and the rest of it. What do you see playing out, generally speaking, in the next 6 months?
Well, interestingly, look, we're probably all sick to death of this, both professionally and personally, but it really, you cannot escape the coronavirus as far as the oil markets or any markets. So at the same time as every few days we're seeing positive news on vaccines, in Europe and in the US, the virus is, resurgent like crazy. To use a technical term, right? So while there may be some optimism on demand, say in the second half of next year, if you're asking about the next 6 months, it's a very cautious time. And if you're a trader, you should be, I would say, there's a lot of risk out there. Don't limit yourself to being bullish, right? You can make as much money off a bearish trade as a bullish trade. Call me master of the obvious, but that really, people say, well, what about OPEC? Yeah, OPEC is important, but OPEC is reacting to demand. In a situation like this, they control marginal sour barrels for the most part. They don't control the global economy. They don't control oil demand. So it really is, again, hate to beat a dead horse, but it really is about the virus. And yet, so
it's
caution is the watchword.
It is, but I think it goes back to what we've just been talking about. I mean, I think there's loads you can do if you don't limit yourself to the outright price. If you go for, okay, China's fine, and maybe more of the Eastern markets are performing better as countries dealing with the virus, well, you can express that. The Asian refinery margin is performing a lot better. It's the refiners are making more profits. It should probably be supportive of the East versus the West contracts, the Singapore gasolines, these kind of things. You can express it. There's interest. That would be my take on it. Whatever's happening, there's a way to express it, but don't limit yourself to buying or selling Brent.
Yeah, absolutely. So I'm just switching gears into, you're getting into specific trading ideas or strategies. Absolutely. Because, as I mentioned, the whole thing about the current weakness in demand because of the virus, it's Europe and the US, so it's Atlantic Basin. So you have regional, if you just think in terms of East-West, whether it's crude, like, Dubai is quite strong versus Brent, for example, or whether it's product cracks, which have a different flavor for sure in Asia than they do in the Atlantic Basin. I totally agree with you. That's where you need to be looking and need to be thinking about. And also within products, I would even say, again, we're the exchange. It's not our job to, give trading advice. But I mean, think, if you say, okay, the coronavirus is killing jet fuel, which is having a knock-on effect on weakening the fundamentals of distillates in general, including gas oil. Okay, well, look at gasoline then. That's a very, look at gasoline as opposed to distillates. Things of that type, very logical. This is common sense stuff.
Yeah, actually, I think it was really interesting. The OPEC idea, they're only limited to their type of grade. So the heavy or medium sours, i.e., cheaper crude, basically, that generally speaking yields more shipping fuel and diesel fuels than it does the petrochemicals and the gasolines, unless you have a great refinery. Interesting point. Even that. So you can already see the OPEC thing at play. So you say OPEC having their production cuts, that's bullish. Yeah, it is. But actually what's unequivocally, impacted just because of OPEC is the sour contracts. So Urals, for instance, Russian, that's medium sour, that's been trading at a premium to the lighter sweet, the North Sea, Atlantic Basin crudes for quite a while and just getting stronger. And that's having a knock-on effect on the shipping fuel, which is performing very well. But I guess my point is there, you just kind of alerted me to it. It's always interesting to say OPEC's impact is sour barrels. Look at how the sour market and the equivalent products that the shipping fuels and the diesel are reacting. Well, shipping fuel is doing really well, as in high price. Sour price is high price. So really what that's saying is OPEC have kind of got diminishing power, because if you've already caused a spike in the contracts you can control, and it's not really having an overall effect, it's kind of telling you that more needs to be done. You see what I mean? If for OPEC to have an overwhelming, you would see it in all the contracts, but you're only seeing it in the sours. It's kind of telling you that, yes, it's bullish generically, but really they need to keep going. It's kind of, I think, but I don't know if you want to make that.
Yeah, well, I mean, 2 points to make there. One, if you just look at the conversations in the oil market and the signals, that are coming out of OPEC plus, just in the last 4 weeks, the conversation has quickly gone from, oh, well, we've scheduled a production increase for January. Forget about that. That does not seem to be on the table anymore. Then the conversation went to, okay, we'll have to roll over current quotas and production for 3 months, then for 6 months. And in the last couple of weeks, you're even starting to get some hints that, I don't know that it's a probability, but, further production cuts, or at least being talked about. Don't know if it's going to happen, but they're at least being talked about. So that goes to your point. The other thing, by the way, just on the sour crudes, we talked about Dubai being strong. You talked about Urals being strong. it in the U.S. as well. And in the last few weeks, there's a lot of talk, and you can see it in prices that Mars, which is the U.S. Gulf Coast, sour marker, if you will. There's much more and more interest from Asia, for example, in buying Mars than there's still light sweet exports are still happening, but the change in the last few weeks is, hey, there's more and more bids for Mars now. So sour crude is tight in all of the key regions, for sure. So
those are dynamics at play that should really be interesting.
Yeah.
Going forward, I think that's just a really good point. I mean, so many people talk about OPEC from a macroeconomic perspective, but there are plenty of signals. If you go look, like talked about Mars, kind of benchmark Gulf Coast for medium sour. There's Urals, which is the Russian. These are all paper contracts that can be traded.
Absolutely.
At very least observed, and to get the data from to derive some conclusions. My lights just come off there. But look, Mike, that was really great. Thanks so much. A very animated conversation, which is always ideal. Actually quite interesting to be a part of, and I hope to listen to as well. So thanks very much for that. And I hope down the line we can have you on again, because that was really great. So thanks for your time.
You're very welcome, Greg. And again, really a pleasure. And yeah, great conversation. And the time just flew by. So I hope it's interesting for your listeners. But happy to do it again anytime.
Thanks. See you later. All right.